Listen-only mode.
Hello everyone and welcome to the ACECRT Financial Wellness Webinar Series. Today we will be going through Quarter 4's Guide to the Markets and Economy, which will provide us with a snapshot of the current state of the economy and stock market. We appreciate all of you taking the time to join us today. A few items to go over before we get started. First, in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A tool on the webinar menu. And at the end of the webinar, we will take some time to go through these. And now I'd like to introduce our guest speaker from JP Morgan, Jack Montague. Jack is the Vice President Client Advisor for JP Morgan Asset Management. Jack has been with JP Morgan Asset Management for 1 year and has for BNY Mellon and Dreyfus Funds in California since 2010. Jack brings to us over a decade of investment management expertise. Jack holds his Bachelor of Science in Finance and Management from SUNY Albany and is a Long Island native. Thank you for leading us through this webinar today, Jack, and now I'll turn it over to you.
Thank you, Tori. I really appreciate you all taking the time to hear the thoughts on the market from JP Morgan and the current state of today's economy, as well as where we see things headed. So we're going to do a couple things on today's call. I do want to give you a quick heads up, however, that with today's being the birth of my first son, John Patrick Montague, I am located in a hallway of St. John's Hospital in Santa Monica. So if we have any disruptions or background noise, please excuse the interruptions, that they will be short-lived and we will be able to carry on. So without further ado, let's just dive in to why I'm here and why I'm speaking on today's call, because we do realize that you have a lot on your plate as investors and plenty of choices on who you choose to work with to help you achieve your financial goals and which platforms and partners you'd like to partner with in the future. So PensionMark was nice enough to ask us to join today's call because of JP Morgan's true market leadership. Obviously, JP Morgan is one of the most respected financial institutions in the world. We serve institutions, we serve high net worth individuals, we serve financial consultants, and individuals like yourself now for over 100 years. But what a lot of investors don't know is that we have been ranked #1 or #2 in mutual fund flows over each of the past 3 years. JP Morgan Asset Management is currently ranked #1 in equity fund flows and #1 in overall flows over the 3-year time frame, which puts us, of course, ahead of all of the other major asset management and mutual fund firms that do distribute advisor-sold mutual funds. So let's talk a little bit about JP Morgan's investment capabilities. I think it's a good backdrop to the Guide to the Markets, which we will be discussing on today's call, because who are the people behind it that are actually making these investment assumptions, who is doing research for you, and that JP Morgan means over 900 investment professionals located in 35 countries globally, and we consider them to be the best and brightest throughout the world. Our products are second to none as well. We have over 50 Morningstar rated 4- and 5-star funds, which is truly important, not to get out there and brag about the depth and breadth of our size of products, but it allows us as a firm to be much more consultative because we don't have to have a separate agenda. We don't need to push 1 or 2 products because those are the only areas that we are having expertise in. We have expertise in all areas of the market, from equities to fixed income to international investing to asset allocation, alternative investment like hedge funds. Our performance also is quite strong. Over the past 10 years, 90% of all of our mutual fund assets have been first or second quartile within their Lipper peer group. So it's got the muster to back the performance as well. So your partnership means a lot to us. And what JP Morgan's partnership to you means bringing our intellectual capital, our resources, and our insights into your daily conversations and to help guide you along the complexities of the markets worldwide and help you invest with objective market information as opposed to investing with emotional behavioral bias. So we have 3 tools that we really use to help investors do this. We have our Market Insights program, which we'll be addressing today in the Guide to the Markets. This is really to help you explain and have better conversations with your friends, with your families, with your significant others about the market and the global economies. We have our Retirement Insights platform, which is designed to help you have insightful conversations and show our thought leadership on important retirement topics. Your local pension market representative can show you a little bit more insights to those programs anytime in the future. And then, of course, we also have our Portfolio Insights, which is designed to help our top clients build better portfolios, invest with confidence, and do a lot of back testing, X-rays that can help justify and guide your investment decisions along the long run. So that's why JP Morgan's here. Again, we thank PensionMark for their partnership, and we thank you for your time. As we know, everyone is very busy. Today's Halloween holiday. I'm sure you have lots of trick-or-treating and fun stuff planned for this evening. So without further ado, let's talk about the agenda for today's conversation. We are going to start by talking about the U.S. economy and how we do see a late recovery warm-up, an obvious sign of a recent pickup in U.S. economic growth, and exactly what that means for investors. Second, we're going to talk about our view on interest rates, a big topic for today, and when they will reverse course and what it means for fixed income investing and why you should not really be scared of rising rates for a variety of assets like consumers, residential real estate, the federal deficit. And the third thing I want to talk about is the investment implications of a rising dollar, because that is a new trend that we're starting to see, and there's a lot of things and real promotions happening there. And then, of course, finally, we're going to address why we are still overweight equities and why we do see potential gains in the future. So what impact is growth really going to have? It's a big question that's on everyone's mind, and the good news is that the U.S. economic growth is picking up and is likely to be sustained for a while. In addition, higher interest rates support the higher dollar, which is the case for being overweight U.S. equities, and it's important to position portfolios for stronger growth. So, Tori, you could go to slide 17 in the guide to the markets. We can take a deeper dive into these slides. So on page 17, you'll actually see the economic growth and the composition of the U.S. growth domestic product. So this page looks at economic growth over the past 50 years, going back to 1965, which, as you can tell by the top orange line, has averaged roughly 3% going back to that 1965 period. In the second quarter of this year, the economy grew at 4.6% year over year, which was compared to the first quarter's negative 2.1% growth. So we are seeing a likely pickup in economic growth from this 2.2%, which is where we have been on average since the expansion begun coming out of the March of 2009 lows, and we do expect to see something closer to a 3% average going forward. Now, government spending will not be booming, of course, but it will also not be detracting from growth any longer. The QE program is coming to an end, and we have hit bottoms in terms of austerity measures in the U.S. We have better growth in real disposable income. We have improvements in consumer attitudes, and in the last 3 years, we estimate that the net worth of all American households has increased by a whopping 33% since, again, March of 2009. So a great takeaway from this chart is just the fair assumption that growth has been lackluster coming out of this recession. If you go back to the early parts of the chart, you'll see that other bull market cycles and other periods of euphoria and real go-go growth markets have far surpassed the average of 3% GDP in the United States, and none of the other drawdown recession bear market periods were even close to as harsh as we saw in the financial crisis of 2009. The numbers behind that drawdown, you'll actually see is we lost roughly $700 billion of economic output in that Great Recession period. It was quite painful, and being a balance sheet crisis as opposed to geopolitical risk or as opposed to a fundamental or technical rotation out of stock in the alternative asset classes has prevented us from growing at a much larger pace. So let's take a look at a quick deeper dive to the cyclical sectors from page 19 of the guide that demonstrates how the abundance of pent-up demand will help grow and continue to stay strong. So the four sectors that we're looking at are light vehicle sales, housing starts, manufacturing and trade inventories, and real capital goods orders. These four cyclical sectors are generally the bellwethers to lead us into bull markets, or also can conversely lead us into bear markets when the technicals turn around. So in the top left chart, we can see that auto sales are back up to trend with 16.4 million units sold in September. While this is below the 17.4 million units that was in August, the last reading, a lot of the decline had to do with the timing of Labor Day this year and also had to do with the severity of the polar vortex and the weather that came out in the first quarter in the Northeast this year. The third quarter overall this year was the strongest quarter for auto sales since the first quarter of 2006, which is highly bullish, and auto sales have recovered, but it's not in our expectation that they will not contribute much to further economic growth. It was nice to have the auto sales improve, but it's not the biggest problem we're facing right now. Housing and capital spending are a much bigger area of the economy than auto sales, and both of those areas exhibit plenty of pent-up demand. As you can see in the lower right chart, you'll see that the 950,000 housing starts in August is well below the 1.35 billion average that we saw in the 1990s. So housing starts is still low, lots of room to grow there. We're actually going to get into the housing affordability and / credit affordability later in the presentation to discuss why we still have some room to grow there and how rising interest rates is actually going to potentially positively impact the housing market, contrary to public opinion. And then, of course, capital goods spending has more room to grow. On the bottom right, you'll see that we have trended past the historical averages, but still far below the other two previous peaks of 2009 and back to the 2000 era. So this is why we've seen a late summer warm-up in the economic growth. So we do see that GDP continuing to expand, and with the four major cyclical sectors still having room to expand, we are not expecting a major recession. While that will not say that there will not be volatility in the markets going forward, because there absolutely will be, we just don't see any significant drawdown for a period of true pain over the long haul. So let's go a little bit further. The next big thing within the U.S. economy that people have been discussing and wildly debating at this point is the unemployment numbers in the United States. So on page 24 of the guide, we will actually show that the extent of the pickup in economic growth in the unemployment numbers, which shows unemployment rate and payroll unemployment, one on the left, one on the right. So while the most recent unemployment numbers were not released at the time that we released this guide, we can now report that unemployment has fallen below its 50-year average to 5.9%. So this is a funny quandary because most people are still under the impression that the unemployment rate is far above average when it is actually not the case. You can walk into any office building, any pub locally, or any holiday party tonight. If you ask the average investor where they think the unemployment rate is in the United States, they're still going to tell you that it's got to be all-time highs or close to it. And actually, the recovery has been trending quite lower for unemployment, which is real positive, and the numbers support that. So we're going to discuss that a little bit further on the next slide on page 25. Because the labor market perspectives are made up by any number of fundamental analysis. Again, this is why it makes it wildly debated, because not only do the Department of Labor's numbers constantly move, but also the way that the numbers are reported are constantly changing, trying to move the cards. So these are JP Morgan's assumptions, and on page 25, the guide will address the reasons why the unemployment rate has continued to tick downward. If you take a look at the top right chart, you'll actually show the decline in the labor force participation rate, a quite steady decline. And while the decline in the labor force participation has contributed to falling unemployment rate, it has also resulted in lower GDP growth and lower payroll employment growth. The main point here is that the decline in labor force participation is a structural change that we're seeing based on the fact that the number of baby boomers turning 65 today was higher than it was 10 years ago, and it will continue to stay at a high plateau for the years to come. The numbers behind that are actually roughly 10,000 baby boomers are to retire every day for the foreseeable future. I don't have the exact date, but it's a lot of people retiring and making lifestyle changes. And as those people leave the labor force, that is why we're seeing a sharp decline in a lot of these rates. Another interesting fact about this that we're starting to look at is the number of Americans with criminal records has been steadily increasing. It's leading to an inability for these people to find jobs due to the stringent standards of hiring managers and human resources in a number of different areas of the economy. Because if you have something I mentioned before, you have a criminal record or any type of felony, you will automatically be, not automatically, but you will generally be screened out as you get run through the computer models for suitability for employment in a number of high-quality companies. So again, just one of the other reasons why we're seeing people starting to take part-time jobs for economic reasons, why we've seen a lot of slack in wage growth, because people accepted any job that they could get over the past 5 years just to have any type of income, while that salary is far below what their educational and what their tenure and experience should really be paying. So there's a number of slack in the labor market, including discouraged workers, part-time workers, which are coming down in the top left chart. And then wage growth has begun to pick up as well. It's not growing faster, of course, because workers and businesses don't recognize that we're running out of available workers. Wages will not move up faster until people and businesses start to realize that labor is in short supply. And when you finally have a short supply of labor, you're finally going to have to pay your employees more money to keep them around and pay up for talent, which we're slowly starting to see in the market, but it's going to be a slow process. So let's go a little bit further. Let's talk about the longer-term effects of the economy on page 22. We're going to talk about the long-term drivers of economic growth here. It is going to look at the chart on the right, which shows unemployment and output per worker. Over the past 50 years, and output growth has been around 3% over that 50-year period. This is split into 1.5% growth in the number of workers and 1.5% growth in real GDP per worker. So productivity has slowed to 1.1% over the past 10 years, and a 1.5% GDP growth per worker is actually very high, and we are more likely to see productivity growth moving forward, as I mentioned before. Employees that are able to be more productive at work but are being held back because of wage inflation, because of the hiring standards. As they get better jobs and move up, we should see them become more productive and putting their intellectual capital back into the markets. Also, the unemployment rate has come down at a pace year over year of 0.8%, and the growth of the labor force itself is only averaged 0.2% over this extension so far. So we're growing at 0.8, but the growth of the labor force is only average 0.2. That's only 25% of the actual people that are being employed. So it's a real benchmark for how much quality we have in the market, how much we have to grow per person growth. So if we continue at the pace we're going at, the unemployment rate will, at this time next year, be roughly at 5.1% in our estimation. And eventually the reduction in the unemployment rate will stop because of higher inflation. And growth will have to come from the labor force rather than a reduction. So this paints a good picture. We do expect people to become more productive, which will go back into the economy. So hopefully things are trending up for some time. So that's really our benchmark and base case for the late summer recovery that we're seeing in the United States for longer-term growth. And on page 32, we're going to transition our thoughts and comments over to the fixed income markets, which are really some of the most interesting areas of today's investors' landscape. And this is one of my favorite charts, actually, in the guide, because you're actually going to look at interest rates are very low by historical standards. you can see this is the trend over the past 30 years, the top blue line. At September 30th of 1981, the U.S. 10-year Treasury nominal yield was at 15.84%, and today we've come down. These numbers are as of September 30th at 2.52. The spot price on the 10-year Treasury today is actually 2.29%. So after inflation of 1.73, call it, on that 2.2, you're only getting a nominal return or real yield after inflation on your fixed income, on average of 50 basis points or 0.50. So really no attraction to interest rates today, fixed income investments, as they are yielding all-time lows. So one of the best ways to describe the changes that can take place in fixed income portfolios and the mentalities of investors is that anyone who's ever been in the trenches or watched a war movie, you know that you use different weapons, different tactics when you are fighting from an elevated position, as opposed to the weapons and tactics you're going to use as you try to fight the uphill battle, which is what we are expecting to see as interest rates either stay lower for longer or in other cases, and what we're going to discuss, if interest rates trend higher, which will have some real risks to fixed income portfolios. So page 35 is actually going to demonstrate why we believe interest rates will rise. Page 35 is a depiction of the Fed's forecast for growth. These are not JP Morgan's on the bottom right chart. You can actually see the Federal Reserve summary of economic projections. So the Fed is expecting growth to pick up to 2.8% in 2015 and 2.8% in 2016, and then fall back to 2.2% in the long run. However, it's their unemployment forecast that has been off throughout this entire expansion. They've predicted that unemployment rate would be 6% in the fourth quarter of 2014, but as we already know, this number is already at 5.9%. So the Fed is expecting unemployment to be at 5.3% at the end of 2016, but we disagree with this. So the reason we disagree with this is very simply that if you take a look at the change in GDP from 2014 to 2015, we're going 2.2% to 2.8%. That is roughly a 25% increase in GDP year over year. However, if you go to the unemployment rate assumptions, they're calling for, again, 6% at the end of this year, which we already know is wrong, and at the end of 2015, a 5.5% number. So if you go back to our comments earlier about unemployment, the year-over-year change in unemployment has been coming down at roughly 0.8%. So with that assumption, that we're only going to fall by 0.4%, is what the Fed's calling for, that is essentially a 50% slowdown in the pace of unemployment gain, while they're calling for a 25% uptick in GDP. So we'll probably get some questions on that after. I hope that was clear to everyone. So essentially it's an anomaly. How can you have higher growth, but how do you have a slowdown with unemployment gain at the same time? So it's unlikely that the Fed is going to actually achieve a soft landing. And the main point here is that we just need to prepare for higher rates. The Fed is calling for, on its FMOC, the bottom of that bottom right here chart, you can see in 2015, they're calling for their federal funds rate at year-end to be at 1.38. That actually is an assumption of 5 interest rate hikes by the Fed next year. And in 2016, at the end of 2016, they're calling for 2.88 on the Fed's fund rate. That is an additional 6 interest rate hikes in 2016. So higher interest rates are coming. We're not exactly sure when it's going to happen, but again, our base case, interest rates will trend higher over the short term. So let's take a look at page 34. It gives a brief description of the impact of fixed income instruments. It shows the total returns on different bonds so far this year. On the far right, you can see the total return for 2014. So if you're looking short term this year, the 30-year Treasury actually achieved a 17.6 return in the first 2 quarters of this year. That is an astronomically large number. However, they were down very sharply last year because we did see interest rates go up. The difference between 2013 and 2014, quickly in interest rates, was 2013 we saw a period of May through September, sparked by Ben Bernanke's famous taper tantrum, where he discussed the possibility of potentially slowing down the then QE program, in which case investors thought interest rates were going to spike, and they did. The 10-year Treasury went up 1.47% in that 5-year period. U.S. Barclays Ag was down roughly 5%. A variety of fixed income investors finished the year negative last year. This year, on the other hand, we've had some real problems with the supply-demand factors that make up federal funds rates, and we've also had some more concerns out of the European double-dip recession, which has created flight to quality, and interest rates have actually come down part of this year. So essentially, it's a great chart because it shows that we need to adjust expectations again due to the fact that rates will most likely rise. However, there is going to be volatility in fixed income, and a lot of the fears that come with rising rates are unjustified. It's actually a natural progression for a healthy economy. But again, work with your local pension market advisor or consultant, and they'll be able to help you navigate the complexities of the fixed income market, find out what makes the most sense for your case. So let's talk briefly about some of the impacts that it's going to have on consumers. We're going to talk about what's going to have the effect on residential real estate and credit conditions, and then we're going to talk briefly about the federal deficit and the expectations from the Congressional Budget Office. But on page 18, you can see the actual consumer finances. So it demonstrates actually how households generally have more money today than they did pretty much any period before. So on the top left chart is what we're going to be looking at. The total liabilities of American consumers today are roughly $14 trillion. It's actually total liabilities 13.9, pardon my rounding up. Whereas the total assets, the bigger left bar, equal about 95 trillion. So this is a 6-to-1 ratio for assets versus liabilities for consumers today. That is a very, very healthy pace. So what we've seen out of the financial crisis was the majority of companies and economies became more efficient. They cut their overhead costs. They really cleaned up their act in terms of spending, and consumers did exactly the same thing. You can see household net worth, which is increased on the bottom right chart, and then household debt to service ratio, which is the ratio of how much, what percentage of your income is going to pay off credit cards, automobile loans, other long-term liabilities. Fourth quarter of 2007, that number was roughly 13.2%. One of the all-time highs that we've seen in terms of debt out there was one of the leading factors to the trouble that we had because investors were just investing beyond their need. They wanted too much leverage. And today, that number is down to almost an all-time low. The second quarter of 2014, measured at 9.9%. So really, really healthy consumers out there, and we don't really expect rising rates to impact them too much. And we're going to talk next about why rising rates will not hurt the housing markets, because there's a lack of housing. There's not a lack of housing affordability. There's actually a lack of mortgage availability, which we're going to dive into on page 20 and page 37 after that. So page 20 is a quick snapshot of residential real estate. You can actually see on the right-hand chart, it shows that the last 40 years, the average household spent that cross orange bar 20.4% of its income to pay off the average mortgage payment in the average home. So this past August, the most recent reading, that number was down 7% to 13.5%. So people have the money. They can buy homes. But on the next slide, we'll talk about how banks just aren't lending. So in other words, for this kind of residential real estate, for example, if you would have to see a rise in interest rates of roughly 50% from where they are currently to get back to average levels of affordability. So for example, if you had a 30-year average mortgage, that mortgage would be pushed up from current levels at 4.2% up to 6.5% in order to get back to average affordability. So to have the affordability index get kicked up back to average, we'd have to see interest rates go up 50%. So again, residential real estate is not at risk of short-term rising rates future, again, when we talk about why it's helpful for rising rates. But again, the key takeaway is that mortgage is highly affordable. It's the real problem is credit. So that's a good transition. Let's jump to page 37. Credit conditions real quick. It dives real into this. Even Fed Chairman Ben Bernanke admitted to having difficulty refinancing his mortgage because of all the paperwork that goes into this. The right-hand chart on page 37 actually shows that the average FICO score for approved loan is 743. Not as high as it was in 2011 times, but still very high compared to traditional mortgage originations. So it's just much tighter than it was before in the housing bubble, even tighter in the immediate aftermath following that housing bubble. So mortgage financing is tough because banks aren't making any profit. This is why raising rates will not hurt the housing affordability, but rather help mortgage availability. As banks make more money on their loans, although when interest rates rise, they can charge more money for a 30-year mortgage than they can charge today. When their profitability margins go up because of those new revenues that they can generate, they will generally ease their lending standards on those FICO scores because they can take more risk into the markets because they have safer cash cushion behind it. So rising rates should actually lead to higher loan growth. And on the bottom left chart, you can actually see the orange line of residential real estate loans, which is trending right at about that zero line. Today we're at 2.5%, and you can see by historical averages that it's still extremely low, even though the top right shows that residential mortgages and delinquency rates have been on a steady decline for the past 2 years. So let's transition quickly. We'll go into the federal finances on page 23. One of the major concerns out there is that rising rates is going to blow up the federal deficit. So page 23 actually shows the Congressional Budget Office's forecast for the federal budget and the deficit and debt through the next decade. So we're looking at the top right chart. And in the CBO's August publication on the budget, it highlights why rising rates will not lead to an explosion of federal debt. The CBO actually assumes that the 10-year Treasury yields will be at 4.7%. Again, we're at 2.29 today, between 2018 and 2024. So while you'll see those forecast numbers on the top right steadily increase to about a 4% deficit, it is by no way going to explode the budget like it did coming out of the financial crisis and those higher levels that we saw in 2009 and 2011. So even if all this happens, Fed's can have manageable levels of debt, barring any changes in terms of spending and revenue. So where will interest rates actually benefit investors? So it's actually going to benefit investors. On page 12, we can show the relationship between rising rates and equity markets. So it shows basically why we don't think interest rates are going to hurt the stock market, again, contrary to public opinion. We are going to show the relationship between stock prices and interest rates, where an increased rates is actually positively correlated with increased stock prices when rates start at low levels. So you can actually read this chart like this. Call it the 2.29% Treasury levels is where we are today. So when rates rise between 2 and 4%, looking at the x-axis here, you can see those orange dots are the positive relationship between 0.2 and 0.4 of rising rates to rising interest rates. So rising interest rates generally happen because the economy is improving and the Fed is trying to stymie hyperinflation and keep the market in control to make sure we don't have any bubbles in asset classes. So generally speaking, when interest rates rise in the beginning part of a recovery, equities will go up as well because the economy is doing better. Now you can see the orange line cut through the middle of the chart right at about 5%. This is an interesting inflection point in our research because what it shows is that after 5%, stocks will actually have a negative correlation to rising interest rates. This comes from investors' risk appetite. When I can turn around and get a 5% CD or a 5% short-term debt obligation, or I can find cash equivalents in money market funds that are paying 4 or 5%, why would I take on risk in the equity markets when I can invest in more fixed income mortgages? So that's where we start to see a changeover. But again, in the foreseeable short term, as interest rates start in the beginning part of the cycle, there is a positive relationship between stocks and fixed income markets. So let's talk about the U.S. dollar and trade on page 28. Nice transition here, because as things are starting to improve, and again, we start to look at more equity-centric investments, page 28 of the guide is going to show the increase in the U.S. dollar on the bottom right-hand side. You can see how we bottomed out in March of 2008, 70.4 relative, and we're currently at 79.8. So it's likely the result of stronger U.S. growth and higher U.S. interest rates. So what does a rising dollar do? It may have negative implications for foreign investment, at least in the short run, but if you take a look at where the opportunities really lie outside the United States, we think there's some real attraction to global equity markets. Page 42, on the left-hand side, will actually show dollar-denominated returns, local currency returns, and this chart may make you wonder why an investor would buy a Eurozone fund. The main reason for this underperformance, particularly in European stocks, has been the rising dollar. The dollar will not rise forever, however, right now it's eating away returns to euros. So if you want to be a contrary investor and buy things when they are cheaper, take a look at the top right chart. So this is actually the weight of the Morgan Stanley Composite Index, the MSCI, all-country world index. And what we're looking at, the top right pie chart, is the percent of the global market cap stocks, 50% of the investable universe in stock and equity is in the United States. But what you also will realize is that 50% of that opportunity set lies outside of our borders. So if you are just limiting yourself to thinking about U.S. stocks, you are putting yourself behind the 8 ball and giving yourself a great disadvantage, because there are opportunities outside of our borders as we start to battle prices that are higher and come to average valuations, and we have a Fed that is most likely going to rise interest rates. You can think outside of our walls, go to Europe, for example, which is trading extremely cheap of volatility of the past 3 weeks, and the European Central Bank, and more notably, Bank of Japan, have come out flat out said that they are going to be lowering interest rates in the near term. So opportunities exist. It's just a matter of where you can find them. So let's take a look at how the dollar will also affect the inflation numbers for the Consumer Price Index on page 27. While a lot of investors are concerned that inflation will pick up, a rising dollar will actually cut important prices of the CPI. We do think that it will eventually rise, inflation we mean, but not quite so soon. A rising dollar tends to cut oil and gasoline prices, to which consumers are particularly sensitive. And if a rising dollar reduces inflation pressures, it's unlikely that inflation will pick up to the average 2% this year, and we're also going to see higher disposable income consumers. So great way to just put this in real life. If you're paying less money at the pump for gas every day, you have more money and change in your pocket to go spend back into the economy. 70% of the U.S. GDP number is made up of consumption. So the more money people spend, the higher growth will be. So really good numbers in terms of low inflation rate. But let's talk more about globally. Rising dollar will have a slight negative impact on big multinational companies, because if Coca-Cola is generating, call it 60% of its returns from outside the United States, but the dollar has made it more expensive for a local emerging market consumer to buy that same can of Coke, they're more likely to go buy an equal product for a lesser value that is cheaper to them. So when it comes to manufacturing, you can actually see the evidence of this on page 44. It's the manufacturing momentum, a real leading indicator. In terms of PMI numbers, a rising dollar is actually going to help the rest of the world, as we just mentioned. The PMI number for the U.S. is roughly at 57.1, which is actually really quite high, and there's an abundance of green near the U.S. What we also note is that there are no solidly red numbers in the September column from a sample set of both international developed and major emerging market consumers. Green means expansion in manufacturing numbers. Red means a decline in manufacturing. So the more people, goods, services that people manufacture worldwide, generally the healthier the global economy will be. So a rising dollar is good for global economy because the U.S. is capacity constrained. The U.S. can only go another year or two with pushing unemployment rates down at these levels, trying to push up inflation, and just running out of capacity, as I said earlier. So a higher dollar actually takes U.S. demand and brings it overseas. So the U.S. can buy foreign assets, other nations have the capacity to produce. So the key takeaway here is that investors should not give up on global growth. The real reason it's been so slow this year is mostly because of the exchange rate, which will not last forever. And while many are under the impression that the world's in turmoil, it's actually growing, which is what we're going to take a look at on the next slide, page 51. We can see that if we look at page 51 to the guide, which shows earnings per share of the U.S., European countries, and emerging market countries, that companies are still well below their prior peaks. Now, this is likely due to a slowdown in China and the second recession that's coming in Europe. Valuations have gone up in Europe, actually, along with the U.S., but are still lower in the emerging markets. So this is evident on the right side of this chart. It means that there's still going to be room for growth, particularly in emerging markets, but also in Europe. Faster growth will turn and support higher PE ratios. So on the right side, you can see the forward price to earnings ratios, the U.S. being the gray bar, the highest recovery levels and best projections for price to earnings going forward. Europe's slightly behind them, but you can see they're starting to trend downwards because of their double dip recession that they're potentially going into. And then emerging markets, the light blue line below that, while trending slightly up but mostly sideways. There's some real cheap opportunities in emerging markets right now. We're just not sure the timing of that's correct. So real brief on equities before we get to questions. I know we've been going for quite some time now. We'll talk quickly about corporate profits and leverage. With another spectacular earnings season behind us, we can actually show how we're poised for another one. The top left chart will show that the second quarter earnings were at 29.45, another record year in terms of earnings. We expect earnings to grow at JP Morgan by about 8 to 9% in the future. And the company's profit margins on the top right are still at all-time highs, trending through about 10.1%. Companies are also operating with a total leverage far below the historical averages, as you can see on the bottom right chart, which basically means companies are not speculating. They are sitting on cash, they're making safe investments, and they're not trying to lever up their portfolios to take on any undue risk at this point. They learn their lesson, or so we hope. So on page 7, if we continue, we can actually show the stock valuation measures of the S&P 500 index. Things look fairly valued right now. Price to earnings latest reading is 15.3 on the S&P 500. If you go to the 25-year average at 15.6, we are right at or slightly below historical average prices. A variety of number of other valuation metrics here will paint that same picture. But we do believe that prices can go up, as we mentioned earlier, and stocks still look more attractive, and bonds just based on real earnings yield, 6.6% for equities, 4.8% bonds. So if average valuations have you worried, you're not alone. Page 11, the next slide, will actually highlight what happens when a bull market reaches its fair value. In 5 out of the past 7 bull markets, equities have moved upward even after reaching fair value. So the way you read this chart on the top left is that the gray chart is the returns of the S&P 500 going from the bottom of a recession or cyclical downturn and getting back to historical average levels. The light blue part is the excess returns, where the market continued to run and gave investors additional returns after average valuation. So simply stated, just because we hit average does not mean that the freight train has to stop and turn around on a dime. It means that there are room to run, and if you believe in top-line revenue growth, deployment of corporate cash through rising dividends, share repurchase programs, and continued M&A activity, we do expect to see some returns far beyond, not far beyond, but at least somewhat past the average valuation. So good numbers there. And last but not least, we're just going to talk about cash. Dr. Kelly, our famed author of the Guide to the Market, who publishes this little booklet that we're going through here, says sitting on cash is like living in your mother's basement. It'll give you something to do, but it's not going to get you anywhere. So companies today currently have $11 trillion sitting on their balance sheet. and they need to put that to work. So through earnings growth, valuations, momentum, and cash levels all support overweights U.S. equities because we do have to get that cash back in the system, and when you have more spending, you're supposed to have higher returns. Last but not least, our recommendations about asset class returns on page 58. Just all asset class returns, including cash, which is essentially paying zero right now. Once investors understand that the global economy is going, they can understand the risk and the opportunities that are out there. And we recommend that you work with your pension or local representative to build a portfolio of stocks, bonds, alternatives, international, and that way you can see the average asset allocation portfolio as measured by the gray bar with the line going through it. You can have middle of the road for average returns while stymieing a lot of the risks in the market. So that is where I'm going to end my comments. Tori, if you would like to open up questions, we can see what the rest of the world thinks.
Great. Thank you so much, Jack. Yes, we will now start addressing some of the questions that have been filtering in. And everyone, please remember that if you have any questions during this time, you can submit them using the Q&A tool on your webinar menu. Our first question is the part-time employment drop to 4.7% in August of 2014 a benefit to the economy? Does this equate to more full-time work opening up?
Absolutely. Absolutely it does. And actually on that chart, you can see that there is a number of metrics that are used when considering that. If you are in a job like financial services, or if you are in the technology sector at a Palo Alto, just looking back to that same slide, reference it here. So it's page slide 25 of the guide. You can actually see that net job creation since February 2010 has been quite healthy in any number of industries. Again, information and financial services, manufacturing and business services, trade and transportation, leisure and hospitality. So yes, it is a long-term driver because people are recognizing the value of their services and the value of their trade that they bring to the table. So when you have companies that are starting to invest into the market and deploy that corporate cash, let's say you're Joe Schmo beverage maker in Idaho, you're about to launch a new product that's going to cut into Coca-Cola's earnings profit margin. Joe Schmo beverage maker is going to hire a new sales force. They're going to try and find people that are seasoned veterans to compete against the behemoths and other blue chip stock names that are out there. So they are going actively into the labor force search for experienced professionals as opposed to people going out there and saying, hey, I'll hire you, but I'm only going to give you 50% of what you're used to making. And over the past 3 years, people had no choice to accept that. So yes, the employed part-time for economic reasons declining is a very strong momentum for the U.S. economy.
Great. Thank you, Jack. Our next question is, what causes the drop in company profit margins? Is that dependent upon the state of the economy?
Yes and no. Yes and no. So we'll start with the no. It does not depend on the state of the economy because we always have to separate economies from companies. Just because an economy is doing very poorly does not mean that a company domiciled within those borders is not making money hand over fist for their investors. We can see that like technology companies coming out of 2008. The economy was at the dumps, but what did more people do? They stayed home and they played more iPhone apps, and played more iPad apps, and they paid the $1 or $2 to get the new Candy Crush saga to continue. So you don't have to be in a good economy to have high profit margins. Where the economics are going to have an impact of it, though, is that profit margins are only at the high levels that we've discussed. Actually, just a kind of tailwind off of our discussion about part-time economic reasons. They're so profitable because they've become so efficient and because they didn't have to pay their workers those historically high average salaries. So as we start to see the labor force supply shrink and we start to see wage employment increase, that'll obviously feed into the earnings profitability of companies, which of course is economically driven. So yes, the answer is sometimes. Okay. So sometimes economically dependent, sometimes just based on the company itself. But both are going to be looked at.
Thank you, Jack. It appears that there are no more questions at this time. so that will conclude this webinar session. Please feel free to reach out to your dedicated service team, the Financial Wellness Help Center, at 844-223-2788 or financialwellness@acecrt.com. Thank you, Jack, and thank you, attendees, for your participation. I hope you all have a great day, and happy Halloween.
Thanks, everyone. Take care.